Hello everyone, my name is Mini Sethi. I hope you all are staying healthy. Today we are going to talk about instruments of monetary policy. As we know, under monetary policy, Central Bank of country control money supply. In order to control money supply, Central Bank uses so many instruments. First of all, we are going to talk about quantitative instruments. First quantitative instrument is cash reserve ratio, or we can say CRR. As we know, so many people deposit their money in commercial bank. CRR is some percentage of commercial bank deposit which they have to keep with central bank in form of cash only. For example, total deposit of commercial bank is 1 crore and they have to keep 5% as a cash with the central bank. It will be called CRR. Second quantitative instrument is statutory liquidity ratio. That means the minimum percentage of commercial bank deposit which they have to maintain with themselves, not with the central bank, in form of cash, gold and security. Means these cash, gold and security they cannot use for credit purpose. They have to maintain with themselves. Next quantitative instruments are repo rate and reverse repo rate. Repo rate is the interest rate the central bank charges when it lends money to commercial bank if any shortfall in their fund. On the other hand, reverse repo rate is the interest rate that the central bank pay to commercial bank for the money which they deposit with central bank. The quantitative instrument is bank rate. Bank rate is also an interest rate that central bank charges while lending money to commercial bank. Main difference between repo rate and bank rate is, in case of repo rate, commercial bank need to keep some security with the central bank as a mortgage, and repo rate deal with short term and immediate requirement. On the other hand, in case of bank rate, commercial bank need not to keep any security and it deal with the long term requirement, and bank rate is more organized as compared to repo rate. Last quantitative instrument is open market operation. Open market operation means buying and selling government securities by central bank in order to control money supply. Open market operation means buying and selling government securities by central bank in order to control money supply. Now we will see qualitative instrument. First qualitative instrument is marginal requirement. Marginal requirement is difference between value of security offered for loans and value of loans granted. Suppose value of security is equal to 1 crore and loan granted is equal to 80 lakh. Difference between both is equal to 20 lakh. This 20 lakh will be called marginal requirement. If central bank want to reduce money supply, then it will increase marginal requirement. As a result, people will take less loans. Eventually, money supply will reduce in economy. Next instrument is rationing credit. Under rationing credit, central bank fix limit of loans for different sector so that no sector is neglected, and commercial bank can give loans within these limit only. Next qualitative instruments are moral suasion and direct action. Under moral suasion, central bank simply advise a commercial bank. For example, money supplies continues increasing. In order to control money supply, central bank simply give advice to commercial bank. During this time period, money supply is already increasing, so don't give so much loans. If commercial bank is not cooperate with the central bank, then central bank can take some direct action against commercial bank. For example, central bank can reject any application of commercial bank. Central bank can impose so many restriction on particular commercial bank. So this is all about instruments of monetary policy. I think you got it, and thank you so much for watching this video. Bye, take care.